Brent just cratered 5% after the US hit pause on Iran strikes. But here's what the herd is missing. The geopolitical risk premium is not dead. Weekly structure still shows buyers defending the $85 zone. Monday's danger level? A break below $85.16 triggers the next leg down. But if we hold, the 3 to 5 day swing targets a recovery toward $92.50. Brent crude just got carved up, 5% drop, from above $101 all the way down to $86.96 as we speak. The headline? US paused strikes on Iran. And the retail crowd? They're panicking, thinking the geopolitical premium is gone, but here's what most traders won't realize until Wednesday. This sell-off might be the week's biggest fakeout. This week has one danger zone and one 3 to 5 day opportunity. I'll show you both right now, stay to the end. I'm giving you 2 Monday scalps and 1 swing trade that can run the next 3 to 5 days. Let's get into it. Here's the structural bias for the next 3 to 5 days. Range bound with a bearish tilt, but with a massive upside trapdoor. Let me be crystal clear. The weekly trend is neutral, the daily is neutral, but the 4-hour and 1-hour are both flashing strong sell. That's a compressed spring. The single invalidation level that flips the entire weekly bias? $85.16 to write this number down. If this level breaks this week, the whole monthly structure resets and we are looking at $79, but here's where it gets interesting. The herd is heavily short coming into this week. They saw the headline, they hit the sell button, and now they're crowded on the wrong side of a potential bounce. The ATR is nearly $12. That's massive volatility. And when you have that kind of range with a crowded short position, you get liquidity runs. The question is, which way? Let me walk you through the chart from the top down. On the weekly time frame, Brent is sitting in a fascinating spot. We spent years consolidating inside a descending channel from 2022 through early 2026, then exploded above $115. The recent correction took us back to retest that broken trend line around $70 to $72, and we got a massive V-shape rejection. Now we're in the retest phase of that rally. The weekly RSI at 50.36 is perfectly neutral, not overbought, not oversold. But the weekly MACD? That histogram is contracting, and we are watching for a potential bullish crossover as price attempts to push back above $100. The weekly moving averages tell a clear story. Price is trading above the MA50 at $82.30, above the MA100 at $79.15, and well above the MA200 at $76.88. That's a bullish macro structure. We haven't broken the uptrend. But the MA20 at $86.66? That's where we are sitting right now. This is the line in the sand, dropped down to the daily. We just got crushed from $101 to $86.96. That's a $14 handle in a single session. The daily MA20 at $86.66 is acting as a magnet. The daily RSI at 50.36 says we are in no man's land, neither overbought nor oversold. But the daily MACD at 1.49, that's still positive, but momentum is rolling over now. The 4-hour, this is where the pain is. Strong sell across the board. Price broke below the 4-hour MA20 at $87.04, and we are testing the 4-hour MA50 at $82.30. The 4-hour MACD is rolling negative. This is the bearish short-term pulse, and the 1-hour? Strong sell. No relief yet. Here's what most traders will miss until Wednesday. The sell-off was purely headline-driven. The fundamental supply picture hasn't changed. The Strait of Hormuz is still a mess. Let me give you the levels that matter. Key support S1, $88.90. This is the first line of defense. Broke. S2, $85.16. This is a level. If this goes, we are talking $79.09 S3, $79.09, the ultimate downside target if the structure collapses. Key resistance are $101.04, the recent spike high. This is the ceiling. A 2, $104.78 a 3, $110.85. The weekly pivot sits at $94.97, and that's the battleground for the week. If we reclaim $94.97, the entire bearish narrative starts to unravel. Now let's connect the dots between the headlines and the price action. The weekend news was simple. Oil slipped more than 5% after the US paused strikes on Iran. But here's the nuance that everyone's missing. I just published a report today saying oil's upside risk is significant. They see three scenarios: baseline at $80, extreme upside at $120, and downside at $60. Barclays just said on Friday that if the Hormuz impasse lasts another 3 months, Brent could test $150. This is not a market that's pricing in peace. It's a market that's reacting to a headline, not a structural shift. The IEA has already warned that global oil supply is on track to decline by 3.7 million barrels per day in 2026, with demand contracting by 1 million barrels per day. That's a tightening market. OPEC just cut its 2026 demand growth forecast again, but raised its 2027 outlook. The long-term picture is supply-constrained. Now the calendar for this week. This is where it gets explosive. Wednesday, July 29th, for 30 p.m. Eastern Standard Time, EIA crude oil inventories. This is the single most important data point for the week. The market is expecting another draw. We've been seeing consistent inventory declines. If we get a bigger than expected draw, watch for a violent squeeze back toward $95 to Wednesday, July 29th, 8 p.m. Eastern Standard Time, Federal Reserve interest rate decision. This is the macro wildcard. If the Fed sounds hawkish, the dollar strengthens and oil gets hit. If they sound dovish, oil rallies. The market is split. No one knows what Wash is going to do. This is why you need tight risk management on Wednesday, Friday, July 31st, Chinese manufacturing PMI. This measures the demand trajectory from the world's largest crude importer. If we get a beat, oil gets a bid into the weekend, and the ongoing geopolitical risk? The Strait of Hormuz, Red Sea shipping routes, and potential escalations in U.S. military strikes. This is not going away. The 1 to 2 week directional lean? Sideways to slightly bullish with a bearish trap. The market is repricing risk, but the underlying supply story remains bullish. Do you think Brent closes above $95 this Friday? Comment yes or no. I'm tracking consensus for the week. Most people skip the planning phase. That's exactly where this week's money is made. Keep watching. Strategy 1. The Monday opening scalping, high probability. This is for the first 1 to 3 hours of Monday's session. We are looking for a fast mean reversion trade off the extreme oversold condition. The trigger, if price retests the $85.16 support zone and holds. I want to see a 5-minute bullish rejection candle, preferably with a wick below $85 and a closeback above $85.50. Entry, $85.60 on 5-minute bullish reclaim of the $85.16 support area. Stop loss, $84.60, that's 100 ticks below. We need room because the ATR is massive. Take profit 1, $87.40. This is the first resistance pocket and a 1 minute and 1.8 seconds risk reward. Take profit 2, $88.90. The S1 level that just broke, now acting as resistance. What instantly voids this scalp? A 5-minute candle that closes below $84.50. That tells me the support is gone and we are heading $4.79. The Monday opening SCLP entry $85.60. 5M bullish reclaim of $85.16 support. Stop loss $84.60. Take profit $1.8740. Take profit $2.88.90. Risk reward 1:1.8R to TP1. 1:3.3R to TP2. Invalidation void if 5M candle closes below $84.50. Strategy 2. The Monday liquidity grab, scalping, counter noise. This one is for the aggressive traders. The smart money loves to hunt stops, and with a 5% drop, there are stops everywhere. The setup, look for a fake breakdown below Friday's low or the Asian session range. We want to see price spike below $85, trigger the retail stops, then snap back with a bullish engulfing candle on the 5-minute or 15-minute. Entry, $85.30 on the snapback confirmation, a 5-minute close above the spike lows. High stop loss, $84.20, just beyond the wick of the fakeout. Take profit 1, $87, fast target at the nearest liquidity pool. Take profit 2, $88.50, extended target if momentum continues. Warning: this requires aggressive execution. You need to be watching the tape, not just the chart. If volume confirms the snapback, this trade can fill in minutes. The Monday liquidity GRB entry $85.30, 5M snapback after fake breakdown below $85. Stop loss $84.20, take profit $1.87.00, take profit $2.88.50 risk. Reward 1:1.5R to TP1. 1:3.2R to TP2 invalidation void if price holds below $84.50 for 2 consecutive 5M candles. Use scalping Monday or swinging the week. Comment scalp or swing. Let's see who's built for this market. Strategy 3. The 3 to 5 day swing. Swing. Trend alignment. This is the main event. Based on the weekly and daily structure, we are looking for a swing long that captures the core move of the whole week. The trigger: a daily close above the MA20 at $86.66 with bullish momentum confirmation. I want to see the daily RSI turning up from 50 and the daily MACD histogram starting to contract. Entry: $87 on a daily close above the MA20. If we get that, the probability of a move toward $92.50 increases significantly. Why? Because the weekly structure is still bullish. We are above the MA50, MA100, and MA200. The $70 to $72 retest held. And Societe Generale just noted that while Brent has slipped below its 50 DMA, a brief rebound is possible, and failure to reclaim $103 would keep downside risks in focus. I'm betting on the rebound. Stop loss, $83. This is below the S2 support at $85.16 and gives us room for volatility. If we close below $83 on the daily, the swing is invalidated. Take profit 1, $92.50, the primary target support zone from the original data. This is a conservative swing target for midweek. Take profit 2, $95, the stretch target for Friday, which aligns with the weekly pivot at $94.97. Trailing stop rule. Once price reaches $89.75, halfway to TP1, move the stop to break even at $87.00. Explicit invalidation. A daily close below $83 negates the weekly outlook and suggests we are heading for $79.09. The 3 to 5 day Swingfield value strategy name with 3 to 5 day swing entry $87. Daily close above MA20 at $86.66. Stop loss $83.00, take profit $1.92.50, take profit $2.95.00 risk. Reward 1:1.4R to TP1. 1:2.0R to TP2 invalidation void if daily close below $83.00. Never risk more than 1 to 2% per trade. Holding through high-impact event days like Wednesday requires tighter sizing. Stops are non-negotiable, especially on the swing with a $4 stop loss. This is how you survive to trade the next big weekly move. And remember, the EIA and Fed on the same day. That's a volatility cocktail. If you're in the swing trade by Wednesday morning, consider scaling back size or taking partial profits before the data hits. Let me summarize the single most critical level to watch for the entire week. $85.16. This is the line. Above it, the bull case stays alive. We are in a range with upside toward $92.50 and $95. Below it, we are talking $79.09 and a complete structural breakdown. The headline-driven sell-off created a massive opportunity, but only if you respect the levels and manage your risk. If this level breaks on Friday, the whole monthly trend flips. I'll have the updated blueprint for you this Sunday. If you want the full breakdown on Aussie dollar, Japanese yen, Nike 225, those videos are live now on our Alpha Market Meridian channel. Gold, Nasdaq, and Bitcoin are published on the Market Meridian channel. Please click the link at the top of this channel's homepage to access the complete institutional suite. Tap the end screen to jump to the gold melt-up analysis and then loop back to today's Nasdaq Gamma flip later. Hold the like button and subscribe. Every signal helps the algorithm bring you the levels that define your week. This is Trade Meridian Decoded channel. Stay sharp, stay disciplined, and I'll see you at the close.